Moving on to part 4, measurement of the elements of the financial statements. There are various different ways in which the elements can be measured in accordance with the framework. First of all, historic cost. Not necessarily just assets, but assets is the example that's being used here. Items recognised in the financial statements at cost minus any depreciation. Liabilities recognised in the financial statements at the value of the consideration received when incurred. In other words, the cash that was received when the liability was created in the first place is the value of the liability. So historic cost is a perfectly acceptable measurement base. Historic cost has significant advantages. It's objective. Very difficult to argue with the historic cost figure. It's factually accurate, isn't it? And it's difficult to manipulate. It's reliable because it's easily verifiable against the original cost documentation. Information is readily available in order to be able to confirm the historic cost of a particular item. And historic cost is also very, very commonly used and very easy to understand. It does, however, have some disadvantages as well. Just list those down on the right hand side there. The values can be outdated. Think of a building perhaps that was acquired 20 years ago that was recorded at cost minus depreciation and could actually be worth millions and millions more than it was originally purchased for in the first place. So the values can be outdated, which I suppose makes the information slightly less relevant, doesn't it? Not as useful for decision making purposes. It's also likely that if taking an asset, a non-current asset that's depreciated as an example, profit might be overstated due to lower expenses. Lower asset value being depreciated to a lower amount, which will mean that profit is overstated. And that could distort some of the ratios. ROCE there, ROCE, return on capital employed, ROA, return on assets. So figures can be distorted, performance indicators could be distorted, and also it might end up misrepresenting financial trends. It doesn't really give you an idea as to what the trend in changing cost is. Now, historic cost is used very frequently. There's nothing wrong with it. It's an acceptable measurement base in accordance with the framework. But there is also an alternative, and the alternative is current value. Current value is actually divided down into 3 different separate component parts, because current value could be any of these 3 here: fair value, value in use, or current cost. So just having a chat about all of these. First of all, fair value. Fair value is essentially market value, isn't it? The estimated value at which an asset can be sold or a liability transferred in an orderly transaction under market conditions. In other words, what could you sell an asset for now? Not what did you buy it for in the first place, or how much has been depreciated by, or what's its carrying value. What could you sell it for now? Now, there might be transaction costs involved in selling an asset now. They are not included as part of the fair value. There's a reference there to IFRS 13. IFRS 13 gives guidance on how you should assess fair value, because market value can be judgmental and subjective, can't it? So there's an accounting standard that gives you guidance on how you should apply it. So current value could be fair value, and some accounting standards recommend that you use that, and the conceptual framework says it's an acceptable alternative measurement base. Alternatively, current value could be value in use, and value in use is not what you're going to sell something for, it's what you're going to get if you keep it. So if you've got an asset, you could decide to sell it and you would get market value for it, or you could decide to keep it. Value in use is, as you can see from the second bullet point down there, present value of future cash flows that an asset generates for a company. So in order to determine value in use, you would need to work out what the cash flows are that relate to a particular asset or liability, discount them back to present value, and you've got your value in use. Alternatively, you can use current cost. Now, all of these 3 are variations on the theme of current value. Some accounting standards specifically require you to use a particular one of these, whereas other accounting standards just say you can use different types, different for the choice effectively, but the conceptual framework says you can use any of them. Current cost. Assets are carried at a cost of what it would cost you to buy a similar equivalent asset now. For a non-current asset, that would be replacement cost. For a liability, that would be the value of the consideration that would be received for an equivalent liability at the date of measurement. Now, it might not be immediately apparent as to what the difference is between fair value and current cost, but I think the example, the actual question that we've got coming up in a minute or two's time will give you a good insight into what the difference is between the two. So you can either say there are two different measurement bases, which is historic cost and current value, or you could say there are four different measurement bases if you subdivide down the current value into fair value, value in use and current cost. So the four overall: historic cost, fair value, value in use and current cost. Advantages of using current value. Well, I think we've already looked at the disadvantages and advantages of using historic cost. Well, the disadvantages of historic cost are the advantages of current value, really. Current value means information is more relevant, more up to date for decision making purposes. It's more accurate for current business conditions, giving a current value. And it probably gives management a little bit more guidance in determining whether or not they're going to hold or sell the asset, because they're not really worried about what it cost them in the first place. They're more concerned about what they would get for it now. Disadvantages are judgment. It's subjective. Current value is subjective to a certain degree, especially if you're using fair value. IFRS 13 helps to a certain extent, but there are some significant disadvantages. Sometimes it might be difficult to obtain current value information. Sometimes there's just too much judgment involved, as we said already. And it would be relatively easy, wouldn't it, for a company to manipulate the current value and to overinflate things or perhaps underinflate things. Now, we're not saying that historic cost or current value are better than each other. We're saying they're both acceptable measurement bases. They both have advantages. They both have disadvantages. Another disadvantage of current value in the right hand corner there is well, there's a potential for inconsistency, isn't there, here? If you are valuing certain assets at current value and others at cost or value in use or whatever, a different measurement base, there's going to be a potential lack of consistency. So hopefully there should be some kind of guidance in place that will prevent that from happening. It'd be very difficult, wouldn't it, to do what's called cherry picking, to say, well, I've got one building that I'll include at a current value because it's worth an awful lot. I've got another building that's not worth very much at all, but it did cost quite a lot, so I'll include it at cost. So there could be a lack of consistency. We've got a question. Let's have a look at the question. Machine was purchased 1st of January X7 for $220,000, useful life of 5 years. Machine is still available, list price of $260,000 on the 31st December X8, so 2 years later the equivalent replacement cost is $260,000. It's estimated that the current machine could be sold for $90,000, so that's the market value, but the company would have to spend $4,000 on transaction costs, so additional direct expenses that relate to the sale. The machine is expected to generate $35,000 per annum for the remainder of its useful life. The cumulative present value of $1 in 3 years' time is 2.7232, assuming a discount rate of 5%. Whenever you're asked to calculate value in use, the chances are you will be given a discount factor, and we're given the discount factor here, so we'll be able to use it. What we're asked to do is calculate the carrying amount of the machine using all of the different measurement bases. So what's the carrying amount of the machine stamped to financial position at the end of December X8, which is 2 years since acquisition, using historic cost, using current cost, using fair value, using value in use. So we'll do each one. Historic cost should be nice and straightforward. Cost of purchase was $220,000. Depreciation will just be $220,000 over 5, but it's 2 years worth of depreciation that will have been charged, isn't it? So $88,000 worth of depreciation, meaning the historic cost carrying value would be $132,000. Current cost Well, we'd need to use the replacement cost for that, 260,000. That's how much it would cost you to replace this item. But that needs to be adjusted for depreciation, doesn't it? So again, we're still assuming a 5-year useful life, and we will be 2 years away through the useful economic life. Therefore, 2 lots of depreciation, 2 lots of 52,000 give 104. Therefore, the current cost, carrying amount or carrying value, will be 156,000. Value in use. Well, value in use is going to be the annual cash flow, 35,000. Multiplied by the discount factor, give you 95,312. Fair value, well, the fair value is just what are you going to get if you sell it, and the fair value is 90,000. Notice it's something that I said a couple of slides ago. If there are any directly related selling costs, those directly related selling costs do not get deducted from fair value. Okay, fair value is just what you would sell it for. The selling costs are additional and do not get included. So 132 for historic cost, 156 for current cost, 95,312 for value in use, 90 for fair value. You can probably see from this how important it would be. Remember comparability we talked about a while ago in session 1? If a company decides that they're going to change the way in which they measure something, that's going to have a significant impact on the figures. That change in measurement would need to be disclosed very clearly so the users can draw useful, relevant, faithfully represented information from it.